What can a retiree do today to de-risk their portfolio?
It's a great question. So the first thing to remember is that when you're dealing with a problem like inflation, there is no good answer. The only way, at least in theory, to perfectly protect yourself from inflation is to have no cash left, zero liquidity.
Welcome to Redefine Retirement with Ryan Wheless, powered by Allied Wealth. This podcast explores how to live a limitless life of abundance in retirement with clarity, purpose, and confidence. Today, we're joined by Dr. E.J. Antoni, Chief Economist at the Heritage Foundation and one of the most sought-after voices on fiscal policy in the country. E.J. holds a PhD in economics, appears regularly on national news outlets, and has testified before Congress on key economic issues facing American families. Stay tuned. This is the conversation you don't want to miss. This guy has literally forgotten more about economics than most people will ever know. Welcome back to Redefine Retirement with Ryan Wheless. Got an incredible guest today. E.J. Antoni is an economist and has probably forgotten most about economics than a lot of us will ever know. And it's an honor to have you on the show today, sir. Thank you so much for joining us.
Oh, it's my pleasure. Thank you for having me.
You're very welcome. And so I want to jump in here, E.J. There's a lot going on right now with the big. It's big. It's beautiful. It's going to be the best thing ever. The big, beautiful bill. And that's my best impersonation of Trump, by the way. I can't do any better than that. But you know, there's a lot going on right now with this big, beautiful bill. And what's really got my eye is we just had Elon Musk depart the DOGE, Department of Government Efficiency. And there was some scuttlebutt about him and Paul Bessent getting into an argument of some kind, and that may be why he left the DOGE. Who knows? But what's really interesting is, as of late, Elon Musk, and I'm reading directly from his Twitter feed right here, bankrupting America is not okay. Kill the bill. A new spending bill should be drafted that doesn't massively grow the deficit and increase the debt ceiling by $5 trillion. And then he's got an actual picture from the movie with Uma Thurman on it. It says Kill Bill Volume 2 was the Kill Bill the movie, right? So what do you think's going on here, bud? Is it possible that this bill's passed the House, it's in the Senate now? Is it possible to get this stuff under control and draft a bill that doesn't increase the deficit?
I think so, absolutely. In fact, I think it's possible to get something together that will not only not increase the deficit, but actually decrease that deficit. Not only do I think it's possible, I think it's absolutely necessary. I'm not sure folks realize just how behind the ball we are right now in terms of getting federal finances back in order, in terms of getting the deficit under control. If the last 5 years have taught us anything, it's that the debt and the deficit do in fact matter. If you're wondering, why did we just have 40-year high inflation? Why did we have the fastest rise in interest rates in also 40 years? It was all because of this runaway, reckless, profligate government spending. If you don't get that under control, you're going to continue to pay the price for it. And by the way, that includes retirees or folks who are at least saving for retirement. Under the Biden administration, we had, for a 3.5-year period there, it was the worst 3.5-year run of the bond market in at least a century. That's insane. I mean, think about how the traditional, not the best, but the traditional setup for retirement has a disproportionate weighting in bonds. Those folks got absolutely crushed. I personally know, unfortunately, some older folks who were about to retire and they now can't because their bond portfolio, which again was most of their retirement account, just got wiped out.
Yeah, it really is interesting that we're still in this facet of utilizing bonds to de-risk a portfolio. And what we found out in 2022, when the bond market, to my knowledge, had one of the worst years it's ever had in history, which is not largely publicized, by the way, that 60-40 or 50-50 portfolio got crushed dramatically, right? And so you're saying that this is largely because bond yields went up. Well, wait a minute, EJ. If bond yields go up, how is that not a good thing for the bond market?
Well, it's because of all the poor folks who bought the bonds before that. I mean, the reason that yields were so low, why we had these basement bottom prices essentially was because the Treasury and the Fed were flooding the market with them. And with the Fed going on such a buying spree, what it essentially did is it pushed down the yields, not just on treasuries, but even commercial paper. I mean, you name it, everything went almost to zero. And so you set up this no-win scenario where even if, let's say, a bank wanted to try to be financially responsible, the only bonds that were available for them to buy, to put into their portfolio on the asset side of their balance sheet, the only stuff that was available was essentially near 0% interest rates. So as soon as interest rates rose, they were stuck with the asset side of their balance sheet paying very low interest rates. But meanwhile, the liability side, that would basically be deposits, they had to pay 4 or 5% to keep deposits. It was a no-win scenario where the only option was going to be a blow up like you had with SVB or First Republic or any of those. I mean, literally the only protection they could have had was interest rate swaps, which is insane that you want a commercial bank to try to you have to introduce that kind of leverage to their balance sheet in order to try to play it safe.
Yeah, it's really interesting. So let me ask you this question. If bonds traditionally have been utilized to de-risk the equities in a portfolio, and clearly that strategy did not work, especially in 2022, and rates, we're seeing yields right now go higher. The 30-year treasuries is getting kind of scary, as a matter of fact.
Exactly. Yeah.
What can a retiree do today to de-risk their portfolio?
It's a great question. So the first thing to remember is that when you're dealing with a problem like inflation, there is no good answer. The only way, at least in theory, to perfectly protect yourself from inflation is to have no cash left, zero liquidity, right? Spend all of your money, put it in stuff, because then what happens? Well, everything should, at least theoretically, rise with the fall of the dollar. Obviously, that's not a good scenario. You have to have cash, right? The whole idea of saving for retirement means you are setting cash aside. So what are the types of things that do well in this scenario of not just steadily rising prices, but volatile interest rates? Historically, gold has been a really good bet. And if you look at how it's performed the last couple of years, it's done extraordinarily well. I was advocating for it at 2,000 an ounce back, what was that? I guess 2 years ago almost now. And again, it's done very, very well. I think it has more room to go, more room to run, I should say. I think it's got there's still some upside to it. So gold is a big one. If you're going to do bonds, you have to start thinking about, unfortunately, you have to start thinking about some leverage there. In other words, you have to start thinking about some financial products that are going to protect you against either inflation or against that kind of volatility in terms of yields. Again, none of these things you would normally recommend to folks in normal times, but we're not in normal times anymore.
Is there any chance from your mindset, and this, you just said something that's going to open up a can of worms for sure, but here's where I'm at. Is there any chance that we get back to what is normal? And let me before you answer that, let me go a little bit further. We're in a situation right now. We're spending $1.8 trillion a year in interest income alone on $37 trillion in debt. And I believe we're going into another $1 trillion in debt every 90 days is what's happening right now. All right. So you mentioned the word collapse. Okay. Is there a scenario where the United States is debt free? Is that possible?
Certainly not in the short term. And in fact, even in the long term, if you want to go debt free, it's going to require a complete revamping of the monetary system, because government debt actually serves as the basis for nearly all of our money, like 99% of our money. Well, maybe not quite that much, but at least 95% of our money is literally just based on government debt. This was part of the reason why after the Civil War, for essentially 50 years there, you had these series of monetary contractions. Yes, there was problems with getting enough gold to back the currency. And then finally, it wasn't until you had major gold strikes in places like California and Alaska that the deflationary politics of the second half of that century subsided. But the other key problem was that after the Civil War, every time the government was substantially paying down debt, it was causing a massive contraction of the money supply. because it was reducing the base. If you want to think of the money supply as an upside down pyramid, and the very, very bottom of the pyramid, that tip, is government debt. So as you reduce that, you were getting rid of huge slices, if you will, pie slices of that pyramid. We're in the exact same situation today, except it's even more so because a far smaller percentage of our money is actually based on gold. The Fed essentially has a very small claim on the gold that we have in this country, and that's it. So the point here is just that as you start paying down that government debt, you're going to have essentially, you're going to have to reintroduce something else to back our currency, or something else on which to base the currency. I think gold would be an ideal, but you could even do something like commercial paper, whatever the case may be.
Gotcha. So is there we hear pay down the debt, and we're looking at, debt to GDP getting out of control. I think we're pushing 6.5% right now. And we need that number to be closer to 3 is my understanding. And you can correct me if I'm wrong on that, by the way, but, going further, I hear it all the time. We have these fear mongers out there, and they're selling these newsletters, and my clients call me and say, Ryan, what about the collapse of the dollar? We're in so much debt. We can't get out of debt. Our GDP is being consumed by debt. The government's spending $1.8 trillion in interest alone on debt, right? On just the interest. Okay. And then if we look at the top U.S. CapEx, Social Security is number 1, right? What we spend money on. Net interest is now number 2, then Medicare, and then national defense, right? So, I mean, is there a scenario here where, there's there's a good amount of debt? Like, what's reasonable? What gets the fear mongers out there to not be able to talk about the collapse of the dollar anymore? Can you talk about that, what that level might be debt wise?
Sure. So here, there's a couple of moving parts here. And I guess maybe if we put it in terms of personal finance, maybe it makes a little more sense.
Sure.
Getting $1 million mortgage for a home for a lot of folks would be perfectly affordable if you could get an interest rate of 0.5%, because your monthly payment's going to be relatively small compared to your income. But jack up that interest rate to 10%, and all of a sudden you need a substantially larger income in order to afford that monthly payment. That is part of the problem that we find ourselves in today, where if you look at not just the size of the debt, which has absolutely exploded, right? It's up. It's a quarter of the debt was acquired in the last 4 or 5 years. So the debt has exploded. That's problematic. That has greatly increased the interest payments on the debt, but so has the interest rate. We are fast approaching a point where we're going to be averaging 5% interest rate on the debt. And although we talk about the debt as $36.2 trillion, which it has been at since the start of the year because of the debt ceiling. But what's been happening since then? Treasury's been burning through cash, which they're going to have to eventually replenish. And we've been conducting extraordinary measures. So that would include things like, instead of putting money into the Social Security Trust Fund, we're just using that cash coming in to pay today's bills. Again, at some point, that money's going to have to be replenished. So what I'm getting at here, Ryan, is the fact that as soon as we lift this debt ceiling, you're going to see Treasury borrow almost $1 trillion within a few days. That's just the sheer volume of Treasury bills they're going to issue. And then we're going to continue borrowing as we continue to run monthly deficits. By September, we're probably at $38 trillion in debt.
Wow.
At 5%. I mean, we're going to blink and all of a sudden we're going to be at 1.8% interest, or it should be $1.8 trillion per year on the debt. That is going to bankrupt the country. And so again, it's not just the size of the debt that's problematic, but it's also the interest rate that we're paying on it. And to your point, we just simply can't afford this. It is literally going to start crowding out other spending in the budget. And so that's the point where the bond vigilantes all of a sudden look at this situation and they say, this is completely untenable. Why on earth am I going to buy a 30-year bond today? I have zero confidence 30 years from now I'm actually going to get my money back. Right? Because I'm looking at the current trajectory. I'm seeing things are already completely unsustainable. And I'm realizing, there's no way that this is going to work out. If I do get my money back at all, it's going to be so inflated that it's basically going to be worthless. And so The only way I'm going to actually buy that 30-year bond now is if I get such a high yield on it that it compensates me for the actual default risk of things going belly up, but also the implicit default risk, which we've had to deal with the last 4 years, where bondholders are getting repaid in dollars that have lost a fifth of their value. And see, this is where, if I can, sorry, I'm going to take us on a bit of a tangent, Ryan, if you don't mind.
This is great. I love this. This is great.
This is where I think what we've been through the last several years and where we still are today requires people to totally rethink some of the basic and fundamental assumptions when it comes to saving for retirement. Even something as simple as, do I want a 401k or a Roth IRA? Because with the Roth, now you have to deal with now you don't have to worry about that inflation premium, right? You're putting in money today and it can grow tax-free. Now, it might grow because of a real increase in value from equity prices, or it could increase simply because of inflation. Well, guess what? With the 401k, you don't get to deduct the increase from inflation. It went in tax-free, and now it's going to come out. Let's say the value of everything in your 401k doubles because the value of the dollar got cut in half. You're going to pay tax on that. You got hosed. So now you not only have to do the normal calculation of deciding, okay, what tax bracket am I in today versus what tax bracket am I in the future? That's all part of that consideration. I get it. But don't forget to add in that inflation premium as well. We're at a point now where if you don't see dramatic, and I mean dramatic, reductions in government spending, particularly at the federal level, there's no way you get out of this problem without either much higher inflation or much higher interest rates. That's it. There is no way to square the circle. In the last 4 years, we got both, right? We got a substantial increase in both inflation rates and interest rates. You're going to have that again, either one or the other, or both. Look, all government spending is paid for. You can pay for it through taxes, you can pay for it through bonds, you can pay for it through inflation. But the sins of the past always catch up to you, be they moral or monetary. Again, there's no way to square that circle. And people need to keep that, in my opinion, people need to keep that in mind when they're having discussions about things like retirement.
So, and I totally agree. And that's an area, we're really big advocates, because what's happened is the 401k plan was introduced to the Internal Revenue Code in 1978. And since that happened, the shift away from pensions has been massive. Right. Mm-hmm. And the onus of saving for retirement has been put on the individual's shoulders. It's your responsibility. You have to save for your own retirement and fund it. But not only that, you also are largely in a do-it-yourself world when it comes to the investments you have to pick, right? Because there's so much information out there about investments. And then to add to the interesting aspects of it is that you look at the return of the market from 1980 to 1999, the return's over 1,000%. That's 3 times the prior 20-year periods in history. And so now we've kind of gone back to this reversion of the mean, where the markets have become more volatile, right? And so it's been a big shift. But in addition to that, you've put all this money away tax deferred. It's grown tax free. Now all the money comes out taxable, right? Now the difference, though, is that if you look at the U.S. debt back in the year 1980, it's nowhere near where we are today. Right. So now you're in a situation to where tax rates in some capacity or form are going to have to go up to deal with this problem. Yet the majority of Americans have saved the majority of their money in a tax infested retirement account.
Exactly. 100%. That's spot on. And so again, the situation that we are in today, you can't take the retirement rules, if you will, of the last 50 years and take all of that as a given and try to apply it today. It's not going to work. You're going to get your clock cleaned like the poor folks have over the last several years. I actually do, each year I do an update to a study that started several years ago, where I look at the inflation adjusted returns of not only not only equities, but also bonds, because that's the typical mix that a lot of folks have in their retirement accounts. I look at what the average 401k account is doing, and the results have been, just absolutely appalling the last several years. Folks have really just gotten crushed by by just following the typical what we used to consider the tried and true methodology. I think unfortunately a lot of financial planners just maybe they got a little intellectually lazy, whatever you want to call it. Everyone thinks like, oh, it'll be different this time, right? This time it'll work out fine. No, it's not. It's not working out fine at all.
Yeah, EJ, it's really interesting too to add to that. A lot of advisors are using historical returns to make future forecast predictions. But if you look at like BlackRock, they go through every year and they go survey all the investment banks out there and they build their forward-looking earnings forecast for various asset classes. And if you look at those numbers, they're pretty sobering. I mean, I think the only thing out there that returns anywhere near what I see competitive advisors running the forecast returns the forecast returns going forward based on historical returns, right, is private equity and private credit space, right? So it's really interesting to see what's happening. I think people should be looking at forward-looking stuff, not historical stuff, because so much has changed.
Right. Yeah. I think a nice parallel is how the insurance market just got absolutely demolished the last several years. And you're seeing insurance premiums on everything from autos to homes and everything in between. Insurance premiums are going through the roof. They have the last couple of years and they're continuing to go up. And the reason for that is these insurance companies had their nice, neat actuarial tables. And with inflation, they all got blown to smithereens. In other words, they were charging premiums given certain repair and replacement costs that they thought were coming down the pike. And all of a sudden, those repair and replacement costs were 2 or 3 times in some instances what they were anticipating. It wasn't just the fact that you had, riots and natural disasters and all kinds of things like that. It was simply the fact that the cost of labor, the cost of materials exploded. And so the insurance companies, had to observe this for a year or two, just completely get crushed financially, suffer massive losses. The reinsurance industry also suffered massive losses. And then they update their actuarial tables and realize, oh, these are the premiums we should be charging folks. I mean, it's not an exaggeration, Ryan, to say that there are folks who had their car insurance premiums double over the course of a year. And so, okay, that's the insurance side. You're seeing that also when it comes to wealth management, I think, where people are having to revisit their equivalent of these actuarial tables, and they're having to redesign, redevelop, re-strategize how on earth we're best going to serve our clients to fit today's circumstances, because this is not yesteryear anymore.
Yeah, it really is. And that's what we call the podcast Redefine Retirement, because it has changed. This is a new world. It operates by a new set of rules. You're dealing with a finite amount of resources when you retire. And your time is your most valuable commodity, and your money is a resource that allows you to enjoy the time you have left on the earth, right? The thing is you don't know how much time you have, and your generation is likely going to live longer than any generation in history. And the biggest threat to retirees today is outliving their money, right? It's really interesting. What do you say to folks that are concerned about outliving their money today, EJ?
It's a very legitimate concern for a couple of different reasons. One of which is simply the fact, not to beat a dead horse here, but the problem of inflation is very, very real, and it's ongoing. And there's no reason to believe that we're going to see the end of it anytime soon. Now, we've made tremendous progress on inflation. In other words, we've brought it way, way down, but you still have the problem of you essentially have a much higher level of prices that are still going up, and you have to make up that gap somehow. In other words, even if prices were to stay steady right now, not increase at all, you would still have to have them hold steady for a decade before you actually get back to the previous trend, to that pre-pandemic trend of prices. That's never going to happen. Prices are going to continue to go up. Hopefully they just go up at a slower rate than they have been, like the Fed's 2% target, let's say. But the fact is, you have had a course change. And so you need to make sure that you have accounted for that difference. Again, I personally know some folks, and I understand, an anecdote is not data. I get that. I'm just using the anecdote because it speaks to the broader data. It's a real example. I know a gentleman who was planning on retiring now 3 years ago. And he basically has to work he estimates probably 4 or 5 years beyond what he thought he was going to have to in order to recoup the losses that he has suffered from inflation. And he, fortunately for him, had an incredibly aggressive portfolio allocation where he had almost no fixed income at all. So he fortunately didn't suffer those losses, but he still suffered the loss of essentially realizing I need about 25% more in my retirement account than I thought I did, just to account for the cost of living. And this is in the particular geographical area where he lives. Obviously, you go to different places around the country,
Sure.
it could be different, right? But still, the fact remains, you need to, in order to try to quell some of those fears, which I think are very real fears, don't ignore them, please. You need to reevaluate, how much do I actually need for retirement? Even if I want to keep my life expectancy the same, the amount that you need in order to make it to that time has clearly increased by a sizable amount. I mean, look, 20% is nothing to sneeze at, right? If you want to retire, I know a very common number used to be $1 million in assets. Now you probably need much more than that. But even if you're just talking $1 million in assets to retire comfortably, now you need an extra 200,000.
That's 20%.
Exactly.
That's 20%. And think about the average American out there, how long it took them to save $1 million. And now they've got to save an extra 200 grand. That's a real number. It was interesting, EJ. We had just before the COVID pandemic and into the COVID pandemic, we work with a lot of engineers at Exxon and other major oil companies here in Houston. And some of the folks were like, hey, I don't want to retire yet. I'm not ready. And they didn't. But the discount rate on their pensions went up, and the lump sum values of their pensions went down. And many of these people worked 2 to 3 years, and the amount of money they made from their job, they lost in their pension lump sum. Yeah. Mind-boggling, right? So, and that's a real threat. And granted, it could go the other way. Rates start going back down. Those lump sum values start increasing. That's how discount rate works. But let's jump back to something we were talking about a minute ago. Because I'm compelled to ask this question, and it's okay. Let's go back to the debt for a minute, and the interest on the debt approaching $1.8 trillion, which is just, I think it's enough money to stack up in $1 bills from the earth to the moon, by the way, in dollar bills. If you stack it up, I think it's about what it comes to. But anyway, so couldn't the Fed just cut rates in half and solve half the problem? Sounds reasonable.
Sure. The problem with the Fed is that they're constantly playing monetary whack-a-mole. Every time they do something, there are always unintended consequences. And very oftentimes, those are worse than the original problem that the Fed sought to fix, right? What the Fed did in 2020 was flood the market with cash in order to try to prevent interest rates from spiking. They accomplished that at the price of 40-year high inflation, and then keeping rates way too low for too long required them to raise those rates very, very quickly. And yes, that helped cool down the inflation. It also gave us a banking crisis and made the cost of living crisis in general even worse. So, let's walk through this. What would happen if the Fed actually cut rates? There's really only one interest rate, one significant interest rate. There's several smaller rates that have to do with individual markets. There's one specific rate that has a big impact that the Fed can set. That's the discount rate. That's the rate when you or I, as a financial institution, let's say we can't find another financial institution from which to borrow, so we go to the Fed. We go to what's called the discount window, and you borrow at the discount rate. That is the only interest rate that the Fed actually sets. All the other rates they target. So the federal funds rate, there's a range for that, and the Fed wants to keep the rate that banks are charging one another, called the Fed funds rate. They want to keep that within a target range. So there's a lower bound and an upper bound. That's their range. The Fed tries to target that by conducting open market operations. And that's essentially where the Fed is buying or selling securities. A lot of people don't realize the Fed has basically like a magical checking account. If I, as the Federal Reserve, want to buy a government bond from you, a bank, I give you money and you give me the bond. I have now created that money literally out of nothing. I wrote a check from an account that had a zero balance. Likewise, though, if we flip that around, you sell me the bond, okay? And we reverse that. Now what happens? Well, now you get the bond, I get the cash, And what happens? The cash goes right back into that account with a zero balance. Poof, it's gone. So the Fed creates, but also extinguishes money in conducting these open market operations. Now, they also have the repo market, the repurchase agreement market. And so there's repos and reverse repos. We don't have to get into that. The point is, though, that the Fed buys and sells securities in order to affect the amount of money that's out there that can be lent. And that's what changes that interest rate. And the Fed wants to keep it within that range. So if the Fed were to cut rates, if they were to cut the discount rate in half, what would happen? Well, everyone would just immediately go to the discount rate and borrow a ton of money. And then they would lend it out to other market participants to try to arbitrage that difference. If they were to cut the Fed funds rate in half, to do that, they would have to go on another giant buying spree and inject massive amounts of liquidity into the system. So in either instance,
both of which are inflationary.
Exactly. You took the words right out of my mouth, Ryan. So in either instance they're pumping all this excess liquidity out there, and it's inflationary. You're absolutely right. So what is the Fed going to do here to solve the problem? I mean, at this point, there's nothing the Fed can do. They have painted themselves into a corner where the only way out is going to be painful. And so it's just a question of what is the least painful option at this point. Really, what the Fed needs to do is stop trying to lead markets around by the nose, stop trying to set rates, follow the market, follow rates. Don't try to set them. In other words, observe what the prevailing rates are in the market, and then just simply set the discount rate at a penalty above that. If the prevailing rate is 5%, set the discount rate at 6%. It's that simple. You want to be the lender of last resort, not the lender of first resort. That's all they need to do.
Interesting. I hope Jerome Powell's watching.
Slow Jerome, as they say.
You've been a critic of Jerome Powell. Can you speak to that a little bit? What kind of mistakes you think he's made, and potentially what he could do better? You just mentioned one, obviously, but what are your thoughts on that?
Oh, goodness. What could he do better? Resign. That would probably be the first thing. What kind of mistakes has he made? Ryan, everything. I mean, let's go back to the first Trump administration. His mistakes started basically as soon as he was made chairman, astonishingly enough. He buys into these failed Keynesian models that really have never worked. And he thought, well, we're seeing all of this economic growth. That means that we're going to have inflation. There's nothing about economic growth that says you're going to have inflation, right? We had economic growth because productivity went up. We had economic growth because there was you might call it a supply side incentive that happened when you reduced marginal tax rates, and all of a sudden people were able to keep more of their money. So those types of things the Fed thought was going to cause inflation, and so they preemptively started hiking interest rates. They were also selling off the balance sheet. In other words, extinguishing money, right? All of this was contractionary, in terms of monetary policy, and they overdid it so much, that contraction, that they caused they actually temporarily lost control of interest rates. And I believe it was September of 2019, the fall of 2019. The Fed, who's in charge of interest rates, actually lost control of interest rates. There was essentially an implosion in the repo market. Mm-hmm. They had to conduct a $500 billion bailout of leveraged hedge funds. But nobody remembers this because right when this was starting to break then in February and early March, I guess, of 2020, COVID happened.
Right.
And everyone was so concerned with that everyone forgot about the Fed's previous failures over essentially the last 2 years. I understand that the Fed wanted to prevent the Treasury market from falling apart. And so in the first couple months of the pandemic, the government imposed lockdowns. The Fed went on a buying spree, a couple $1 trillion worth. Okay, I get it. That was enough. Time to stop. Put the brakes on, go back to selling off the balance sheet at a slow and steady pace. And instead, they just kept buying and buying and buying. And then the Fed kept making promises to the banking system saying, we're not going to raise rates. Rates are going to stay low indefinitely. There is no plan on the horizon in the near term to raise interest rates. And so what happened? Everyone kept loading up on these near zero yield securities because they thought that's the best thing there's going to be for the foreseeable future. So if you want a low risk or a no risk rate of return, this is all there is. The absolute flood of liquidity blew just a massive bubble throughout the economy.
That's what Ben Bernanke called the helicopter money.
Exactly, Ryan. So whether it was real estate, whether it was equities, you name it, just prices everywhere went through the roof. And then, Jerome, who was up for renomination, purposely kept interest rates at those artificially low levels until after his confirmation. In fact, we forget right before the Senate voted on his confirmation, he had to testify, and he told the world that raising rates by 0.75 of a percentage point, 75 basis points, he says that's off the table. It's not going to happen. As soon as he's confirmed, what does he do? He gives us 4 of those jumbo-sized rate hikes in a row.
Yeah, pretty quickly.
And by the way, that kind of political pressure between the White House and the Fed, that goes both ways, because the Biden administration was purposely stonewalling. They waited months longer than they should have. Looking at the calendar, they waited months longer than they should have to actually renominate him. Why? Because they wanted to keep the screws on him, keep the pressure on him to keep the interest rates low. So again, the political pressure, there's a two-way street. It's not as if Jerome was the only bad actor there, although he certainly was. Again, fastest interest rate hikes in 40 years, worst inflation in 40 years. He has absolutely wrecked the bond market. We have a banking system with over $400 billion right now in unrealized losses. And because of what the Fed has done with the repo market, and then also this crazy policy of paying interest on reserves, not even excess reserves, but literally just any reserves, the Fed they basically now pay about $460 billion a day in interest. They have realized losses right now of over $250 billion. It's insane. And that's money that you and I as taxpayers are paying for, because normally what happens with Fed operations is the money that they make, because don't forget, they're buying securities with money they create out of nothing. So they're acquiring assets at zero cost, right? So once they cover their liabilities, which should theoretically just be their cost of operation, again, now it includes all these interest payments. So you take the money coming in, which they got for free, you subtract out their cost of operation, the rest, the profit, goes to the Treasury. It's what we call remittances. Today, there are no remittances. There haven't been any since September of 2022. The consequence of that is the taxpayers have missed out on probably $500 billion of remittances from the Fed. That's money that the Fed should have been sending to the Treasury and hasn't. That is a direct cost to taxpayers.
Who was the Economist? He served as the Treasury Secretary. Trying to remember his name. It'll come to me. David Walker has come out and said any future debt, any additional debt, is nothing more than a future increase in taxes that we're going to pay at some point in time in the future. Right.
Right.
So what do retirees do with this tax situation? I mean, what's a good thing for someone to do to deal with taxation in retirement around IRA distributions, Social Security, Medicare, IRMA? What are some strategies you might be able to share with our audience here to kind of help their money go further, keep more in their pocket, and put less in Uncle Sam's pocket? Sure.
Great question. Unfortunately, some of the answers here are probably going to be uncomfortable for retirees, because they necessitate taking on more risk. They necessitate leverage, things that I would not ordinarily ever recommend for somebody when you're talking about a retirement account. But the problem is that these are the only ways to get around some of the problems that we face today. For example, if you're going to buy, if you're going to look at tips, right? Tips are only a good buy, or I bonds. Those things are only a good buy if you expect inflation to get worse in the future. If that doesn't materialize, you lose out on that bet. You would have been better off with just regular 20 or 30 year bonds, right? All else being equal. So unfortunately, you have to start looking at instruments like that. You also have to be very conscious of, since you brought up timing of distributions and things like that, I think you need to be very conscious of the fact that tax rates are very likely going to be higher in the future. Marginal tax rates are likely going to be higher. Inflation is likely going to be worse in the future. I hate to be the bearer of bad news here, but look, there's just no way you get out of the mess that we are in today. There's no way you get out of the hole that we have dug for ourselves without a massive wealth transfer from the American people to the government. Now, that could be explicitly done through those higher tax rates. It could be done implicitly, though, through inflation. But it's going to happen one way or another. So whatever you can do to, I would say, shift those penalties from the future to today is a good thing.
So we're big advocates of Roth IRA conversions at Allied Wealth. Oftentimes we suggest people delay Social Security. So if someone retired at 60, let's go ahead and start those conversions. Fill up your current tax bracket. So a married couple right now in the U.S. can have around $132,000 in income and still be in the 12% effective tax bracket. Well, about 11.8% effective rate, but 12% bracket. So we're encouraging people to at least fill that bracket up. For our wealthier clients, we move up to the next bracket, right? And the next bracket after that. But ultimately, we're trying to keep a max conversion rate of about 24% on the tax liability for our clients. And the reason why that is, even though this bill, the big, beautiful bills on the Senate floor right now being probably a lot of kabuki theater going on with it, I'm sure. Right. But, ultimately the tax cuts may get extended, but the biggest risk that we see for our clients is legislative risk. Because even though these tax cuts just got expended, you will suffer 18 to 20 elections in your retirement lifespan. Right. And every time there's new elections, guess what? Policies can change. Nothing is permanent in Washington, D.C. Everything can change and be undone.
Right. Exactly. That's 100% right. And again, if we look at where we are headed right now, actually forget where we're headed. Let's just look at where we are right now. This is completely unsustainable. And not only is it unsustainable, but if you look at how we got here, all of the unfunded spending that happened over the last 5 years, only about half of it was paid for with inflation. The rest was taken on in terms of new debt. So if you think the cost of living increase that we've experienced the last 4 or 5 years, if you think that's bad, realize that we've only paid for half of our overspending. We got to go through all that all over again. The question is it going to be a further worsening of cost of living, or is it going to be just higher taxation? One of the things that, oh gosh, I don't know, Ryan, how much you want to say this is well, let me put it this way. This is probably not a strategy available to a lot of folks who, it's a location, a geographical problem. One of the really great ways to protect yourself against both inflation and higher taxation in the future is to get your hands on assets today, right? So that means buying a house, let's say today, buying property today versus trying to do it in the future. But one of the big keys there is going to be property taxes, because we find this is a big problem in Texas now, where you guys are. It is. Right. When I was working at the Texas Public Policy Foundation in Austin, we were constantly trying to lobby the legislature essentially to use government surplus to buy down property tax rates or find other cost saving measures within the budget to get those property tax rates down, because they're punitively high rates. Let's just call it what it is in Texas. That's the one area of taxation in which Texas really, really needs to get their act together, because they're not there right now. But I've spoken to plenty of folks, some of whom I've advised, where they have literally based their decision on where to retire based on their property taxes. That was the deciding factor at the end of the day, because their biggest asset, even bigger than all of their financial accounts, was their home. And so when they picked up and moved to a different location, they essentially just sold their home and wherever they were, like upstate New York, and put all of the proceeds of that asset into the purchase of another asset to just buy that for cash. So sold a $2 million home here, bought a $2 million home in Arizona. That I think has to be, again, part of this whole consideration, part of the strategy, because even if you do protect yourself in that way, by spending your money today, by getting your hands on an asset today, you don't necessarily then have to worry about the higher marginal income tax rates in the future, but you do still have to worry about those higher property tax rates. And I understand that property tax rates aren't part of the federal calculation. Usually they're not part of the state calculation either. It's typically a local municipality thing, right? But still, when you get into these tough times and these unorthodox times, I think you gotta be willing to look at all of this with a fresh set of eyes.
I totally agree with you. And, we can also, when you're talking about property taxes, I think it's super important because that impacts us all. Unless we decide to rent, there's a lot of folks are moving more towards renting. We're seeing that. And that's an awesome thing because one of my happiest clients, by the way, owned a home for 35 years, sold his home, moved into a high rise. And he said, Ryan, this is the best living I've ever done. If the light bulb goes out, I call a maintenance guy and he comes up here and fixes the light bulb. So a lot of people we're seeing in Texas are actually shifting to renting because, in essence, your home isn't really an asset if you have to pay for the utilities, pay the property taxes, pay to keep it up. In retirement, an asset should pay you.
Right. No, it's a really, really good point. And actually, I find the same thing, Ryan, when I talk to a lot of young people today, because despite the fact that rents have never been higher, right? The premium to own a home today compared to renting has also never been so high. That's how unaffordable housing is today. And so it's amazing how we've really kind of created this bifurcated economy, this almost like barbell distribution, where you have on one hand the folks who bought a home before 2020 and the rest of the people who didn't and now may never be able to buy a home, right? But to your point, I agree. You have to start looking at this stuff as, all right, this home, how do I ultimately want to dispose of this asset? Do I want to pass it on to one of my kids? Do I need this as part of my nest egg in terms of the value? I should say for generating revenue, right? As you said, an asset is something that should be giving to you, not taking from you. And that is ultimately what a home becomes for a lot of folks, where, like you said, you're constantly having to pay utilities, having to pay for the upkeep, like repair bills, for example. It's definitely a very, very important consideration, especially when you do have that abnormally high premium today that allows you to sell a home and then rent for a longer period of time than you would have been able to 6 or 7 years ago, right? So let's say selling a home today might buy you, this is just a random number, but let's say it buys you 30 years of rent versus 5 or 6 years ago, selling that home would have bought you 10 or 20 years of rent.
Yeah, it really is interesting. And then the other aspect too, we'd be remiss if we didn't talk about is IRMA, income related monthly adjusted amount on Medicare. Right. I mean, that's a big impact. And what's really mind boggling to me, EJ, is that, you have this thing called MAGI, which is modified adjusted gross income, which is what your taxation under Social Security is calculated off of. It's also what IRMA is calculated off of. Right. And what's mind boggling to me is that modified adjusted gross income includes the interest from tax-free municipal bonds. So what are your thoughts on IRMA and the Medicare system?
Oh, goodness. I would completely revamp the whole thing, if not get rid of it entirely. Look, the problem with a lot of these systems is that I think you can broadly dump them into one of two categories. One is Ponzi schemes, and that may sound harsh, but it's true. You talk about some of these programs where you spend your life paying into them, and then at retirement, you're supposed to get benefits from them, right? So in your old age, you're supposed to get Social Security. You're supposed to get Medicare. And the thinking is, well, I've been paying into this program my whole life. Isn't it going into like my account or something like that? No, it's not. You are the income coming into those systems today is being used to pay today's beneficiaries, today's recipients. This idea that somehow the money is yours, it's not true. And it requires an ever-growing number of people coming into the system in order to keep that system operating. It is basically like a Ponzi scheme. In a Ponzi scheme, I'm investing money today. I'm a new investor. I'd throw my money into the Ponzi scheme, and that money is used to pay out somebody who joined a year or 2 years ago. And you have to keep adding those investors to keep paying out the previous investors. It sounds really harsh, but that's how a lot of these systems are set up. So you have that problem. How on earth do you reform that? I mean, you really can't unwind a Ponzi, right? It eventually comes crashing down.
Somebody's going to get hurt.
Exactly. And see, this is where, the only really, I guess you could say, safe way to do it, if you want to call it that, and this is why it hasn't happened yet, it's completely politically unpalatable, would be to say to younger folks, look, you're going to have to continue paying into this system for the next 30 or 40 years, but you're never going to get a dime from it. We need you to keep paying in, though, because there's a bunch of people right now who are retired or about to retire who need to get their money, because we can't just pull the rug out from under them, right? But you're eventually going to have to do that. If you don't do that, then the trust funds behind these programs are just going to run out of money. And then you're going to get mandatory cuts where there's literally just not enough money coming in today to pay for today's benefits. And so the benefits just have automatic cuts built into the budget.
Or the premiums will be so high for Medicare Part B and prescription drug that everybody will be health insurance broke, right? You can be house broke, car broke, right? But now we're going to be health insurance broke because we're paying so much for health insurance. But it's got to be that way because it's so costly. It's mind-boggling.
Right. So this brings me to the second part here, which is that a lot of these programs are so costly and so inefficient, so ineffective that they require the private market to always have a backup. And they don't even become a backup. They basically become the go-to. And the government side of it ends up being the backup. And I think private health insurance is really that for a lot of retirees, Ryan, where the government plans, so often, you can't even find doctors in some locations to take these plans. And so you end up in a situation where you basically become wholly reliant on the private sector counterpart. So this is the other part of a lot of these programs where they become so costly and so ineffective that you end up having to have a kind of private sector counterpart. And the private sector counterpart isn't even necessarily the backup. A lot of times it supplants the original government program. And so what you end up with is the government program, like the original Medicare, let's say, ends up just kind of being the backup. It gets used sometimes in certain instances, but it's not the primary thing that you have to rely on. And so you have to then take into account, okay, in retirement now, I have to have this additional expense over here because I can no longer rely on this program over here.
And it just seems to me, Bud, that, we spend time talking to folks. Listen, when you retire, you stop putting money into your 401k. And what you think you're doing is saving. And technically you are, but that 401k contribution is an expense in retirement. It's an expense while you're working to fund your retirement. So what we're saying is just across the board, retirement in itself in the future, because of inflation, because of taxation, because of healthcare, is just going to be more expensive.
Yeah, exactly, 100%. And you can't count on a lot of these government services anymore because you just have to accept the fact that they could very likely be one of the things that are on the chopping block. If we look at let me kind of take a step back, Ryan, and say that a lot of people today talk about Social Security, Medicare, Medicaid, and they say, oh, these things are really breaking the back of the federal budget. It's really not. Though today they're not. In 10 years, it'll be catastrophic, right? You have to make significant cuts to these entitlements. Today, it's not the big driver, though. Today, the big driver has been all the discretionary spending that we've thrown onto the budget. I mean, the last 5 years, if you didn't have the last big blowout spending bill in 2020, ARPA in 2021, the CHIPS Act, the infrastructure bill, the IRA, Inflation Reduction Act, not individual retirement account. If you don't have all of those blowout multi-trillion-dollar spending bills, believe it or not, you have a balanced budget today. That just speaks to how much revenues have grown in this country and how what we've inflicted upon ourselves the last several years did not have to happen. Now, all that being said, the entitlement programs are on a completely unsustainable trajectory where you're getting that exponential growth at the same time the money going into those systems is flatlining. So that's a huge problem. And in 10 years, it's going to require significant cuts. Today, it's not the big driver of the deficit. Okay. But again, in the future, you have to go into that with the understanding of these entitlements are probably going to be one of the things on the chopping block, because by then they are going to be one of the primary drivers of the debt and deficit.
So EJ, recently we've seen a massive uptick in gold prices. And a lot of my clients and prospective clients want to know in our audience, they want to know about gold, right? But my question is a little bit deeper than that, because people have been buying gold and silver as a hedge against inflation and potential dollar collapse and that sort of thing. What's up with the silver market? Why has silver, why has gold gone parabolic against silver when both of them are somewhat of a currency hedge and an inflation hedge? Great
question. And a lot of that, Ryan, just has to do with the fact that it's harder to get gold than it is to get silver. It literally just comes down to one being more abundant than the other, and the stock and flow ratios of each. In other words, if you look at the quantity of gold and the quantity of silver versus the rate at which you can get more of each of those, you find that gold is just much more limited. And so even if both are hedges, which you're right, they're hedges against inflation, they're hedges against currency debasement, you should expect to see a bigger increase in gold because it's just harder to come by. This is part of the reason why several precious metals like platinum, palladium, those types of things, rhodium, they haven't kept up in price anywhere near what gold or silver have done. In fact, a couple of them have actually gone down in price. And it just has to do with their abundance and the fact that we've been able to get a lot more out of the ground. A lot of that has to do with their increased use in industry, like in catalytic converters in cars, for example, and sometimes in jewelry as well, depends on the application. But for the case of rhodium, whatever the case, the idea is just that you basically are dealing with the fundamental market components of supply and demand here, and that's it.
Interesting. That's very interesting. EJ, let's talk about the for a quick minute here. I know we're running out of time here, but there's talk of tariffs, right? And I did some math. I think it was we took in $2.2 trillion of tax revenue in 2023. It might not be the exact number. I think it's pretty close. And then we had it's $80 billion in tariff revenue in 2023. Okay. And then we had $3 billion of imports, right? So in essence, to get rid of the taxes and replace it with tariffs, we've got to tax the imports of $3 billion at 70% to make up the $2.1 trillion shortfall that the current tariff revenues don't make up, or at least in 2023 didn't make up. I mean, what are your thoughts on this? Is Trump going to be able to bring it home here with these tariffs, or are we just spinning our wheels here?
Look, it's a bit of a mixed bag. That's probably the best way to put it, Ryan. One of the things that has really worried me is the way in which some people have decided to take a victory lap on the increase in tariff revenue, for example, from the month of March and even into April. What that was a result of was not the higher tariff rates. That was the result of front-running tariffs. In other words, there was this huge import surge where people wanted to get stuff into the country before the higher tariff rates took effect. And so it wasn't a function of a higher tax rate. It was a function of a broader tax base that created that massive increase in tariff revenue for a single month. And now we can expect it to plummet back down to earth because imports just fell like 60 or 70% just last month. It's remarkably similar to what we saw in 1930 when they signed the Hawley-Smoot Tariff Act. because when that happened, there was a massive surge to get stuff into the country before all those higher import duties took effect. And when the government did its bookkeeping at the end of the year, at the end of the fiscal year, which was shortly after the law was signed, actually, the Treasury was looking through the books and said, wow, this is great. We are raking in tons and tons of money. And now at these higher tariff rates, we're going to rake in even more. No, you're not. It plummeted. The revenue, the tax receipts absolutely collapsed. And I'm fearful that we're going to see something similar to that today. In terms of, okay, how much can we actually expect to get in from these tariffs? Is it going to be enough, for example, to replace the income tax? No, it's not. Now, if you shrink government spending down to 3 or 5% of the economy, which is what it used to be for a very long time, sure, then you can start having that discussion. But international trade is just simply not big enough. And when you consider the fact that there's a dynamic effect here, in other words, as you start increasing taxes on international trade, you're going to get less of it, because if you tax something, you get less of it. The result is going to be less international trade, not more. So at the end of the day, could you put a small dent in the problem? Absolutely. In other words, if you raise $100 billion in tariff revenue, you could reduce personal income tax revenue by $100 billion. Sure. And I'm happy to make that swap, by the way, because not all of tariffs are paid by Americans. A large chunk of it ends up getting paid by foreigners. And since it's our Navy policing the world's sea lanes, I think it makes perfect sense that foreigners who are benefiting from international trade with us should help pay for the thing that protects that international trade. But again, all that to say, you're still not going to replace, for example, the entire personal income tax with higher tariff revenue. The math just isn't there.
Yeah, that I agree with you. And I also think that the abolishment of the IRS conversation is probably a non-starter as well. It's not going to happen. Certainly the IRS could get more efficient. My understanding is that for every dollar the IRS collects in taxes, they spend anywhere from 30 to 40 cents on that dollar to collect the taxes. So certainly some efficiencies could come there in a big way.
Mm-hmm. And that's actually, Ryan, that if you don't mind, that's the big reason. That's the big reason why I'm a huge supporter of no tax on tips. Now, there's also a work incentive there where if I'm going to work particularly hard at my service job because that means I'll get a higher tip, which means I'm not going to have to pay tax on it. But the IRS spends dollar for dollar in terms of compliance. In other words, if the IRS wants to collect another dollar from tipped income, they have to spend a dollar to do it. In other words, it's a complete wash. So eliminating that is a huge source of the kind of efficiency improvement that I think you're getting at, Ryan.
Yeah, it would be, listen, I don't mind paying my fair share of taxes. All right. But if we could take that spend, let's say it's 40 cents on the dollar, and we cut that in half. Well, that means there's 20% increased revenue to go to the government to get us out of this mess that we're in. Right. And also, I don't care if you're Democrat, Republican, LBGQ2Q, that doesn't matter. If you earn money in this country, on that dollar you earn, you pay taxes, which makes you a shareholder. And you should absolutely care how much of your money actually goes to what it's supposed to go for versus in collections. It's a bad business, and it does need some reform. It does need some change in a big way. Let me ask you this. Do you think something like a flat tax could come into play, and could that be, a possibility of eliminating some of this inefficiency and some of the revenue issues?
Oh, absolutely. And one of the problems with the progressive marginal tax rate system that we have today, where as you start earning more income, the marginal tax rate goes up and up and up, is the fact that as soon as you get beyond 25 or 20%, depends on which analysis you look at, the wealthy start doing two things. One, they simply start earning less. So you shrink the tax base and you get less tax revenue. But the second big problem is that they engage in both tax evasion and tax avoidance. Now, tax evasion is obviously illegal. Tax avoidance is not. That's right. I go out and instead of buying a corporate bond, I go out and I buy a muni instead. That's tax avoidance, and it's perfectly legal, right? There are all kinds of things built into the tax code to allow for that increase in tax avoidance, because what happens is the wealthy donor class to the politicians will demand those different carve-outs for themselves, and the middle class is the one left holding the bag. And so no matter how much you jack up those top marginal tax rates, you never actually get more revenue than if you just had a top marginal tax rate of 25%, believe it or not. That's how bad the decrease in economic activity and also the increase in tax avoidance becomes. So if you want to really maximize revenue, just very simple, set everyone's tax rate at 25%. Now, ideally, I'd like to see it more like 10%. I'm not concerned about maximizing revenue. I'm more concerned about maximizing economic freedom. But whatever the case may be, you will not get more money out of the rich at a tax rate beyond 25%. So even if you want to have a lower rate for everyone else at 10%, and then, I don't know, once you hit $250,000 or $500,000, let's say now you're in that 25% marginal tax bracket, don't go beyond that. You go beyond that, you're actually decreasing the net revenue that you're going to see at the Treasury.
Yeah, and I agree with you. And I'm a big economic expansion guy. I can tell you right now, if I would have paid less taxes last year than I did, I would have additional offices opened up in Houston. I would have more employees out there, and all that's good for economic growth in the country. Which in itself, by the way, if I go hire 4 new employees, I'm now paying them a wage. They're paying tax on that wage. They take their money, they go spend it at HEB, they go spend it at Target. Those people are earning a wage. Those jobs dropping into the economy create a ripple effect of tax revenue. And I think so many people don't see it that way. And it's interesting, the dichotomy there.
Yeah, exactly. The Laffer curve is a very real phenomenon. It has been thoroughly documented for over 100 years now, since the introduction of the federal income tax. And it is very, very clear, painstakingly so, that every time we have increased that top marginal tax rate, anytime we get beyond 25%, which has basically been almost the entirety of the existence of that federal income tax, the actual share of taxes paid by the top 1% doesn't go up, it goes down. Economic growth doesn't go up, it dips below trend. And those in the lowest income brackets end up paying a larger share of overall tax revenue than they had before. In fact, people like to talk about how income inequality goes down after you increase marginal tax rates, and that's true. But it's simply true because everyone becomes worse off, but they're converging at the same point. In other words, some people are becoming worse off faster than others, but everyone ends up being worse off. It's just, it really is a shame that people don't seem to understand that very simple lesson of economics, that we, for whatever reason, have to painfully relearn it time after time.
EJ, thank you so much. I have thoroughly enjoyed this. This has been a great conversation. I think we've added a lot of value to our audience and what they're trying to accomplish. And thanks again. I just really can't thank you enough for dropping your knowledge bombs on us today.
Ryan, pleasure's all mine. Thank you for having me.
All right, be well. Folks, that'll do it. We'll see you soon. Stay tuned. Subscribe to Redefine Retirement on YouTube, Spotify, or wherever you listen to podcasts.